Good morning. The Subcommittee on Capital Markets will come to order. Without objection, the Chair is authorized to declare a recess of the committee at any time. This hearing is titled Oversight of the SEC's Division of Trading and Markets. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the Chair for inclusion in the record. I now recognize myself for 5 minutes to give an opening statement. I want to thank you all for joining us this morning. Today's meeting represents the first in a long overdue series of hearings where we will hear directly from division directors at the Securities and Exchange Commission. Given the historic and unprecedented volume of proposed rulemakings being advanced at the SEC under Chair Gensler, it is imperative that this committee hold public hearings featuring the SEC staff responsible for overseeing these rulemakings. Today's witnesses are important because the SEC's Division of Trading and Markets impacts a wide variety of stakeholders participating in our public markets, including millions of Main Street investors saving for retirement, a down payment on a house, or their children's future. I'd also like to note that it's been more than 4 years since this committee has had the SEC's Division of Trading and Markets testify, and I can assure you that that will not be the case under our leadership. Just last December, the SEC advanced 4 proposed rulemakings that will dramatically overhaul our current market structure and how it functions. Typically, when agencies seek to make meaningful reforms, they do so by advancing one targeted proposal at a time and by presenting clear and convincing evidence of a problem or failure warranting such a drastic policy change. In the case of market structure reform proposals under Chair Gensler, the SEC has done neither. Instead of starting with one surgical proposal and observing its impacts after implementation to assess the need for additional proposals, Chair Gensler and Director Zhu have taken a wrecking ball to every corner of our current equity market structure in one fell swoop. And they've done so without any definitive explanation or identifying any systemic market problems or failures. You might be saying to yourself, well, surely the SEC can point to some economic effects of the proposals that justify such major reforms. But yet again, the SEC comes up short. Throughout its economic analysis of the proposals, the SEC explicitly concedes numerous times that the economic effects of the proposals are unknowable. If that wasn't enough, the SEC's economic analysis are also improperly based on data that the SEC itself admits is outdated and inaccurate. For example, to justify 3 of the 4 proposals, the SEC utilizes Rule 605 reports, which provide trade execution quality information monthly. At the same time, the SEC staff has acknowledged that these reports have limitations and need reform. These deficiencies are not limited to the market structure proposals put forward by the Division of Trading and Markets. The division has authored additional proposals that inexplicably overlap and for which their impacts have been inadequately analyzed. It is vital the SEC only issue regulations that are absolutely necessary to avoid burdening Main Street investors. That is why I will be introducing the SEC Regulatory Accountability Act. This legislation, which has passed in previous Congresses with strong bipartisan support, will make sure the SEC does not arbitrarily implement unwarranted and complex rules. My bill would statutorily require the SEC to identify the problem a proposed regulation is seeking to address and conduct a thorough cost-benefit analysis before using any regulation. I would urge my colleagues to join me in protecting the capital markets that millions of Americans rely on for financial security and prosperity. I look forward to partnering with my colleagues on this subcommittee on both sides of the aisle to ensure U.S. equity markets remain the envy of the world and continue to work on behalf of market participants of all sizes, as well as our constituents trying to save for the American dream. The chair would now recognize the ranking member of the Subcommittee on Capital Markets, the gentleman from California, Mr. Sherman, for 4 minutes for an opening statement.
Thank you, Madam Chair, for having this hearing, and I look forward to hearing from hopefully every division head at the SEC before this subcommittee in the weeks and months to come. I want to commend the SEC for working hard and doing the job, and I assure you that there's more than one problem for you to work on at the present time. One issue is payment for order flow. Many investors would be surprised to find out that often their broker is getting paid by people on the other side of the transaction. We are told that this payment for order flow allows brokers to provide free commissions, free trading. Often the most expensive price you can pay for any service is free. And in this case, the commission you save may be more than compensated for by the price spread. Current SEC regulations seem to say that any price improvement constitutes the very best price. That is not fair. That is not true. In fact, the SEC has estimated the current system causes investors to lose $1.5 billion a year because they're not getting the very most price improvement. The SEC is wrestling with this issue, and that makes sense. The witnesses here oversee securities exchanges. The securities exchanges with the biggest problem are the crypto exchanges, which the SEC has correctly determined are indeed securities exchanges. In this room, last July, I had hearings with the head of enforcement in which I urged them to go after the crypto exchanges. The SEC was a little slow. FTX cost billions of dollars to investors around the world. Finally, we're going after the crypto exchanges. I'm concerned about one SEC proposal, and that is swing pricing. There are those that say that if we just at certain times tell mutual fund investors that the markets are unsteady, we may have a disaster, therefore please don't sell your stocks, and if you do, or your mutual fund shares, and if you do, you're going to be subject to an additional charge. That is like telling people on the Titanic that there'll be an extra couple $100 fee for getting on the lifeboat. That's not the way to get people to calmly get on the lifeboats. The idea that in a crowded theater, you're going to, where people are yelling fire, you're going to stabilize the situation by imposing a fee on anybody who goes to the exits is a good way to keep people out of the theater all the time. We need for people to invest for their retirement and to build America by investing in mutual funds, and swing pricing will do just the opposite. I'm particularly concerned about the spring pricing rules because of its horrendously discriminatory effect on those of us who live by the Pacific Ocean. People would have to get their orders in by 10 a.m. Eastern Time. That's 7 a.m. California, 4 a.m. for Hawaii. Let's not adopt a rule that says that those of us who live by the Pacific will be treated worse. Finally, we have before us the division heads that deal with the credit rating agencies. Talking about those who rate bonds. These are the folks who gave AAA to Alt-A and gave us the near depression of 2008. We continue to have a situation in which the issuer selects the bond rating agency that will rate the quality of their bonds. Al Franken and I had a provision that the SEC has conveniently ignored and sidestepped to begin a system where the SEC will choose the bond rating agency. I assure you that if you let the Dodgers pick the umpires, we'd be in first place. And the idea that the issuer can select the bond rating agency, and the bond rating agency cannot be sued under, they say, the First Amendment, if they give too high a rating, is a recipe for what we experienced in 2008. We'll probably experience something in a decade or two similar if the SEC doesn't act on this, and I yield back.
The chair now recognizes the ranking member of the full Financial Services Committee, Ms. Waters, for 1 minute.
Thank you. Last Congress, Republicans threatened that the SEC Chair Gensler would testify very frequently, but they seem reluctant, if not afraid, to hear what he thinks about their crypto markets bill, and I can understand why. Chair Gensler not only has expertise in securities markets, but he also served as the chair of the Commodity Futures Trading Commission and taught courses on crypto at MIT. Instead, Republicans will discuss legislation to give Wall Street avenues to sue the SEC over any future rulemaking under the guise of, quote, cost-benefit analysis, quote, unquote. We know that for Wall Street, there's no benefit that justifies their costs, and apparently for Republicans, there's no benefit from hearing from the person who knows the cost of their crypto bill. I yield back.
Today, we welcome the testimony of Dr. Jessica Wachter. Dr. Wachter is the Chief Economist and Director of Economic and Risk Analysis at the SEC. Previously, she was with the Wharton School at the University of Pennsylvania. Dr. Haosheng Zhu, Mr. Zhu is the Director of SEC's Division of Trading and Markets and a Professor of Finance at the Massachusetts Institute of Technology. We thank each of you for taking the time to be here, and each of you will be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Dr. Wachter, you are now recognized for 5 minutes to give your oral remarks. And please pull the microphone up to your, thank you very much.
Thank you and good morning, Chairman Wagner, Ranking Member Sherman, and members of the subcommittee. It is my pleasure to be here today. I am the Commission's Chief Economist and the Director of the Division of Economic and Risk Analysis, or DERA. Today, I am testifying in my official capacity as the Chief Economist and Director of DERA, but my testimony does not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. I know that many of you may not be familiar with my division's work, so I wanted to give you a little bit of information about who we are and what we do. DERA was established in 2009 from a merger of the Office of Risk Assessment and the Office of the Chief Economist. DERA is made up of over 170 economists, statisticians.
Excuse me, doctor, if you could bring the microphone closer.
I'm having a hard time hearing you.
Okay, is that better? So engineers, attorneys, accountants, and other staff. Better. These experts provide support to every aspect of the Commission's mission, from rule writing to enforcement. As of May 31st, DERA had over 100 PhD economists working on rule writing, litigation support, and risk analysis. High-quality economic analysis is an essential part of SEC rulemaking. It helps ensure, among other things, that decisions to propose and adopt rules are informed by the best available information about a rule's likely economic consequences, and it allows the Commission to consider a rule's potential benefits and costs when determining if a rule is in the public interest. As a result, DERA is actively involved in the Commission's policy and rulemaking function. In Commission rulemakings, DERA's Office of Policy Economics conducts an economic analysis that examines the costs and benefits as well as effects on efficiency, competition, and capital formation of that rulemaking. As a general matter, the economic analysis contains a statement of the need for the proposed action, a baseline against which to measure the likely economic consequences, alternative approaches, and an evaluation of the benefits and costs of the proposed regulatory action. Finally, we also analyze the effects on efficiency, competition, and capital formation. In conducting the economic analysis, DERA staff work closely with staff from the policy divisions, including the Division of Trading and Markets, from the earliest stages of policy development through the finalization of a particular rule. In addition to working on rulemaking and policy matters, DERA economists also support the Commission's examination and enforcement functions by by providing rigorous economic analysis and data analytics. We help identify securities law violations, quantify harm to investors, calculate ill-gotten gains, and assist enforcement with returning funds to harmed investors. DERA's Office of Litigation Economics also provides expert testimony in enforcement matters. DERA staff perform risk analyses in addition of the capital formations to inform the Commission and those outside. High-quality data greatly facilitate our economic analyses. Indeed, data and data analytics are becoming increasingly important to the successful accomplishment of the SEC's mission. To meet the increased demand for data analytics, DERA's data scientists and engineers develop tools and perform analyses in support of the entire Commission. This includes working with SEC's other divisions and offices to ensure data structuring approaches for required disclosures, validation rules, and data quality assessments meet the needs for which they're designed, as well as advanced machine learning algorithms where necessary. In sum, DERA staff deliver high-quality, data-driven analyses that are critical to the SEC's mission of protecting investors, facilitating capital formation, and ensuring fair, orderly, and efficient markets. It is my great pleasure to serve at the SEC. I have been very privileged to study financial markets and to teach the next leaders of our financial industry for more than 20 years. Our markets are the deepest and most liquid in the world, and I am honored that in this position I am able to help them continue to grow and thrive. Thank you again for inviting me, and I look forward to answering your questions.
Thank you. Director Zhu, you are now recognized for 5 minutes for your oral remarks.
Good morning, Chairman Wachter, Ranking Member Sherman, and the members of the subcommittee. My name is Haoshan Zhu, the Director of Division of Trading Markets at the Securities and Exchange Commission. It is my honor and pleasure to appear in front of you today to discuss the division's work. I'm testifying in my official capacity as the Director of Trading Markets, but my testimony does not necessarily reflect the views of the Commission, the Commissioners, or other members of the staff. The Division of Trading Markets was one of the original divisions of the SEC when it was established in 1934. As the name implies, the primary task of the division is to oversee the trading of securities. As technology and market practices evolve, the role of the division evolves with it. Today, there are, broadly speaking, 3 layers of market activities and intermediaries that come under the remit of the division. The first layer is marketplaces. This broad category includes national security exchanges, as well as alternative trading systems and security-based swap execution facilities. Generally, if a marketplace trades any security, stocks, bonds, options, security-based swaps, among others, it is in the remit of trading markets. The second layer is broker-dealers. Because broker-dealers are key intermediaries for investors to access the market, they are subject to rigorous regulatory requirements about net capital, customer protection, record-keeping, sales practice, and investment recommendations, among others. The third and last layer is clearing agencies, including clearinghouses and central securities depositories. They are important for the efficient clearance and settlement of securities transactions. The division also oversees transfer agents, which maintain the issuer's security holder records, among other functions. I should add that exchanges, FINRA, and clearing agencies are all self-regulatory organizations. Securities laws require that SROs file their proposed rules and rule changes with the Commission, and the filings are subject to Commission review and the notice and comments. Based on the most recent data, the Division of Trading Markets oversees 24 national security exchanges, about 100 alternative trading systems, over 3,500 broker-dealers, 48 security-based swap dealers, 7 registered clearing agencies, and over 300 transfer agents. In fiscal year 2022, the division processed about 2,000 filings from SROs, including exchanges, FINRA, and clearing agencies. Behind these numbers are the approximately 270 staff members in the division who spend countless hours reviewing documents, writing Commission releases and orders, and meeting with the registrants and market participants. Our day-to-day regulatory work produces another dividend, which is that division staff identify market evolutions that are significant enough to warrant updates to our rulebooks. Of course, if Congress decides to update securities laws, we implement congressional mandates. Under Chair Gensler, over 60% of rule proposals and adoptions recommended by the Division of Trade and Markets received unanimous votes from the Commission. Our current rule-making work falls into 4 broad areas. The first area is to finish the mandates from the Dodd-Frank Act of 2010. The second area focuses on strengthening the U.S. Treasuries market. The third area is to update our rules on equity market structure. And the fourth area focuses on the interaction between technology and financial regulation. In all areas of rulemaking, the staff in the division thoroughly consider comment letters received and actively engage with the market participants before making policy recommendations for the Commission to consider. We closely collaborate with colleagues in the Division of Economic Risk Analysis, the Office of General Counsel, and other divisions and offices. We are working hard to fulfill the mission, protect investors, promote fair, orderly, and efficient markets, and facilitate capital formation. I'd like to conclude with a personal note. 16 years ago, I set foot in this great country to pursue a better life. I'm grateful that the United States took me in as one of its 330 million proud citizens. I had a good career as a financial economist before coming to public service. It's been my honor and privilege to serve at the Commission for the past 18 months. Our work is deeply technical, but underneath it is a far simpler and more profound goal: to keep the U.S. capital markets, and indeed the United States, as the envy of the world. Thank you.
Thank you, Dr. Zhu. We'll now turn to member questions, and I recognize myself for 5 minutes for questioning. Dr. Wachter, you are the Director of the Division of Economic Risk and Analysis, DERA. While DERA's economic analyses in each of the individual equity market structure proposals are significantly flawed and deficient, the most noteworthy flaw across every proposal is the SEC's failure to reasonably attempt to quantify their costs and benefits. The SEC repeatedly admits that it is, and I quote, unable to quantify, estimate, or know the economic effects, and it states nearly 100 times that it is, again, uncertain of the impacts its proposals will have. As a chief economist, you are willfully ignoring your duty to provide adequate economic analysis, ma'am. For example, nearly half of the data tables in the best execution proposal's economic analysis are virtually identical to tables presented in the order competition proposal. Is it standard practice for the SEC to copy and paste parts of its economic analysis for 2 separate proposals, ma'am?
Chairman, thank you for your interest in our economic analysis on the equity market structure proposals. And
I'm asking about the copy and paste.
about copy-paste. So the economic analysis has several different parts, and one very important part is the baseline. The baseline is the world as it is. So we have to measure costs and benefits against some flat line, the world as it is. So for each of those 4 proposals, there's going to be some commonality, and that's why you'll see some of the text repeated between them.
But ma'am, you haven't quantified their costs and benefits. 100 times you say you don't know, you're uncertain. And as I said, my question is specifically, is it standard practice for you to cut and paste parts of your economic analysis for 2 separate proposals? Yes or no?
So, Chairman, when the baselines are...
Okay, ma'am, I need to reclaim my time. I'd like you to answer the specific questions. Do you agree that these proposals could interact with each other? For example, the order competition rule needs to comply with the best execution rule, correct? Yes or no?
So, the order competition rule and the best execution rule do solve different problems. And Both of the costs and benefits in each of those separate rules are going to be evaluated.
They interact with each other.
Against the baseline. And they
Okay,
are.
I don't know what this baseline is, but we're going to move on. Director Zhu, typically significant market structure reforms have been carried out with comprehensive outreach to investors and businesses, broker-dealers, exchanges, and various other market participants before formal rulemaking. However, in this instance, the SEC appears to be moving at a breakneck speed without giving the public an adequate opportunity to meaningfully comment on the proposed changes. In 2005, when the SEC adopted Regulation National Market Systems, Reg NMS, it held multiple public hearings and roundtables, convened an advisory committee, issued several concept releases, and gave adequate comment periods allowing for ample public input. Why hasn't the SEC done any of these things this time around or provided any justification for the pace and the breadth of these rulemakings, sir?
Chair Wagner, thank you for the question. The public engagement part is extremely important for us in the rulemaking process. Before we propose regulation, the unequity market releases in December, there were extensive discussion with the market participants all the years before. I would say ever since the adoption of Regulation AMS in 2005, the ongoing discussion has been really fruitful. And in fact, some of the ideas that we eventually learn from the market come from the market itself, including lower access fee, including lower tick size, including reform to Rule 605. So my answer to you, Madam, is that indeed we have engaged actively with the market.
Okay, Dr. Wachter, let's try again. Each of these four rules are significant and will have a material impact on trading outcomes for millions of investors. With the rules scheduled to go into effect simultaneously, how can you, as the director of DARA, with a straight face, claim to measure to what degree each of the four rules contributed to or a better or worse outcome for investors? Wouldn't it make more sense to issue them incrementally so each rule's efficacy could be measured distinctly?
Chairman, so you're concerned about the interaction of the rules should the proposals be adopted. So right now, these are four proposals, they're proposed rules. And so we're measuring the economic effects against the baseline, which is actually our standard practice.
All right, my time has expired, and in fact, I'm over it, so I will still give you a little extra time. Chair now recognizes the distinguished ranking member, Ms. Sherman, for 5 minutes for questions.
I want to praise you and your colleagues at the SEC for your hard work and your dedication to solving many problems, and to do it at the same time. And I especially want to commend you for going after the crypto exchanges. But in my time, I want to try to get you, to push you in the right direction in some area, one area particularly where I think you're getting it wrong. People up here, especially by, say, for example, myself, are here because we understand people. I've won 13 elections in spite of my personality and my looks, because I understand my district. And this swing pricing seems like the worst idea you could have in trying to achieve our objectives. We want people to save in an orderly way for their retirement, not day trading, not putting all their money in a single stock. We need people to invest in American equities, not foreign equities and certainly not crypto. And the swing pricing seems to be designed, and not for the purpose, but with the effect of deterring investments, particularly in equity mutual funds. The administration is absolutely dedicated to getting rid of junk fees. And yet swing pricing looks like such a giant junk fee that it would make an airline CEO blush. You're told, I'm old enough to remember when mutual funds had loads. You had to pay extra money to get out or to get in. Thank God we don't have that anymore. But swing pricing imposes a load right when you might want to sell. Imagine trying to have a ticket on an airline and they say, we charge you extra if you use the life preserver. I wouldn't fly that airline. The idea that we're going to stabilize markets and cause people not to sell their mutual fund shares at a tough time. Again, if I was dumb enough to buy a ticket on an airline that said, do we charge extra for the life preservers, you can be sure that I'd pay and use the life preservers if I thought they were needed. In fact, I'd be more interested in putting on the life preserver before the plane even took off. Dr. Wachter, have you done a detailed, peer-reviewed economic analysis on how these swing fees would deter interest in investing in American mutual funds?
Ranking member, thank you for your interest in the swing pricing.
Oh, please, yes or no?
Swing pricing proposal, let me say.
Yes or no?
So our economic analysis on the proposal.
Look, I'm going to reclaim my time if you want to answer the question. Have you done the work, and has it been peer-reviewed?
We have done the work.
You have done the work. Has it been peer-reviewed?
It has been put out for public comment.
It has been put out for public comment. And what analysis did you do to conclude that telling people that just when they want to sell the stock is when they're going to be deterred from selling the stock, and oh, by the way, if you live near the Pacific Ocean, you're going to be particularly oppressed. And for some reason, that didn't deter people from investing in mutual funds? On what basis did you reach that?
So, ranking member, we did do the analysis, and we share your concerns about those costs that you mentioned. And so those costs are in our economic analysis.
I'm not so concerned as the cost. I'm concerned about the effect on investors. Junk fees. It's not the $20. It's the it's the lack of simplicity. I want to buy an airplane ticket, pay so much, get to my destination. I want to know what it is. I want to put my money into a mutual fund, pay a little fee for them to manage it, and get my money out at net asset value when I want it out. You complicate that. You make it, and investors particularly, when they see something they don't understand, they think they're getting ripped off. You're saying your economic analysis shows that this isn't going to deter investment?
Congressman, so we do talk about that in our economic analysis in the swing pricing rule. The problem that this rule is designed to address is, given how the net asset value is calculated right now in some mutual funds, we have a situation where some investors may be subject to
It's
dilution.
not some mutual funds. Every single mutual fund in this country could use swing pricing, and I think 0.0 have decided to do it, so we're dealing with all mutual funds. There's not a single mutual fund seeking investment that has thought that investors would choose them if they went to a swing pricing system because then investors would think it was fair.
Gentleman's time has expired. And before we move on, I would ask our witnesses to please answer the questions in an expeditious, clear, and direct fashion to our members of Congress who have to perform oversight on both sides of the aisle. Thank you. The gentleman from Michigan, Mr. Heising, the chairman of the Subcommittee on Oversight and Investigation, is now recognized for 5 minutes.
Thank you, Madam Chair. And I was going to start by, please don't start your answer with, thank you for asking me this great question. I know it's a great question. So, Director Zhu, Director Wachter, I'm going to jump in. I want to start off by discussing SEC Proposed Rule 10b-1, Position Reporting of Large Security-Based Swaps. Dr. Craig Lewis of Vanderbilt, who interestingly had your job, Dr. Wachter, under Chair Mary Shapiro, conducted a review of your economic analysis for Proposed Rule 10b-1, and I'd like to submit that report for the record, Madam Chair.
So ordered.
In the course of this review, Dr. Lewis discovered that the Commission repeatedly mischaracterized the academic research it relied on to support public disclosure of positions. In one instance, the Commission quoted a paper asserting it was in support of public disclosure of positions, when in fact the paper did not discuss public disclosure at all. Director Zhu, have you conducted an internal investigation to determine how this mischaracterization occurred and who was responsible? Quickly.
Congressman, the objective of Rule 10b-1 is a Dodd-Frank.
I don't want to know the objective. I want to know whether you have conducted an investigation to determine whether these mischaracterizations, who's responsible for them.
Congressman, I joined the SEC in December 2021. That's right at the moment.
And I joined Congress in 2011. Madam Chair, can we please, would you stop stalling? If not, then I would respectfully suggest that we have another hearing with you in front of us so we can get 10 minutes of you stalling instead of 5 minutes of stalling.
We're on the road to that, Mr. Huizinga. Please answer the members of Congress question.
All right, have you retroactively examined other SEC releases to ensure that they do not contain similar misrepresentations? Yes or no? Dr. Zhu.
Congressman, we make sure that whatever we say in the release achieve the policy objective of transparency and the investor protection.
Have you gone back to review that, yes or no? I will take this as a no. Okay, what steps has the Commission taken to correct the record to accurately convey the views of these distinguished academics?
I'm not familiar with that particular letter you refer to.
It's a study, and we will get you a copy of that. So this will be in writing, the questions that I can't apparently get answers to today. So given that the Commission has heavily relied on the summary of the academic literature, have you notified the Commissioners that your summary is in fact unreliable? Yes or no?
Congressman, on 10b-1, it is a live rulemaking. In fact, earlier this week.
Okay, reclaiming my time. All right. I'm concerned that you have just made the agency legally vulnerable to challenges in court. Are you concerned about that?
We published a reopening of 10b-1 earlier this week. So that is, that went into the public domain. And
okay, I guess I'll take that as an I don't care. All right, moving on. I know people watching this hearing, and maybe even some of my friends on the other side, believe that this is somehow partisan, when in fact it's simply not true. Last December, Congressman Gottheimer and I sent Chair Gensler a bipartisan letter on the SEC's market structure proposal. In response to our letter, the chair noted, quote, as is the case in all rulemaking activities, these proposals were developed by experienced staff from across the Commission, close quote. That statement is particularly noteworthy that given just months prior, the SEC's own Inspector General released a report about their concerns surrounding the level of expertise used when crafting many of the proposed rules in question. So Director Wachter, please, quickly, the SEC has been very active and issued a number of proposals over the last 2 years. Yes or no? Do you believe DERA has had the proper time to be able to provide robust economic analysis to each of the proposals that sufficiently explores all impacts?
Congressman, as the director of DERA, I concur on all the economic analysis, and
you believe you've had sufficient time? You've had sufficient time.
Sufficient time? We conduct a robust economic analysis.
All right. The Consolidated Appropriations Act of 2023 instructed the Commission to reconduct their economic analysis on the proposed rule for private fund advisors. Has your division completed that directive from Congress?
Congressman, we are currently evaluating the comment file on that proposal, and we...
So you have not completed it. Okay, in my remaining 10 seconds, February 22nd letter to Chair Gensler asked whether or not the SEC had considered an economic impact of the climate disclosure rule on energy prices. The response I got was a repackaging of the rule itself. I will be following up, but yeah, pray tell me that somebody has done the analysis. And Madam Chair, again, to the objections, this is ridiculous. This is absolutely ridiculous. And whether we have to do investigations and closed questioning, we have got to get to the bottom of these.
Gentleman's time has expired. I now recognize a gentleman from Georgia, Mr. Scott. He's recognized for 5 minutes. Mr. Scott.
Thank you very much. First, Dr. Walker, I understand you're an associate of the Wachter School of Finance at the University of Pennsylvania. I'm a graduate of the Wachter School, University of Pennsylvania. Got my MBA there, served on the executive board of directors, and I want to give you a special welcome to the House Financial Services Committee. Now, Dr. Walker, Director Shu, our capital markets are the world's gold standard. And in recent years, new investors that began trading and investing in markets have been younger and more racially diverse and have come from lower incomes, more so than prior generations of investors. And I want to compliment you on that. These are welcome trends given the critical role of our capital markets in enabling individuals to obtain good, solid financial security. And this is why I'm pleased to see the SEC pursue updates to Rule 605, data through the disclosure of order execution information proposal, particularly by expanding the scope and content of the information that is closed. However, currently, only market centers like national security exchanges, over-the-counter market makers, and alternative trading systems are required to produce publicly available monthly execution quality reports. So what I want to ask you, Director Shu, is taking into account the changes in equity market conditions and the technological advancements which have eroded the effectiveness of Rule 605, tell me this, does the SEC believe they have the most accurate, up-to-date data available to support adopting the other three equity market structure proposals?
Well, thank you, Congressman. First, I want to say that what you mentioned earlier about a broader participation in equity market, younger, more diverse population, I think that is indeed a phenomenon to be celebrated. To your question about the 605, this data was, I guess, adopted in 2000, and for the 20 years or so, it's been providing valuable information to the market. And currently, we are trying to expand the coverage of Rule 605, as well as adding to the granularity of this data set. So this data has been used for rulemaking in the equity market structure releases. And we believe that while this data could be made more perfect, it is sufficiently informative for us to rely on it.
Wouldn't you agree that if adopted, the proposal would significantly expand the data that is made available to the public about execution quality of equity transitions? Yes or no?
If adopted, it will, as to the granularity.
Okay, so you're saying yes. Let me ask you this while I have a moment left. Would the commission consider delaying the other three proposals until you can use the updated Rule 605 data?
Congressman, that's also a comment shared by many commenters in the comment file, and we consider our comments submitted in this manner, and including this one.
Well, I believe that the comprehensive and accurate data is critical to enabling regulators and market participants to make the most informed decisions. So that is very important, using the latest, most available statistics. Many of these decisions financially are life and death decisions, moving up or moving down the economic ladder. Thank you to both our witnesses for being here today, and I yield back the balance of my time.
Gentleman yields back. Chair now recognizes the gentleman from Arkansas, Mr. Hill, the chairman of the Digital Assets Subcommittee, for 5 minutes.
Thank you, Chairwoman. The SEC has been working on the consolidated audit trail for a long time, almost a decade. And during my 9.5 years in Congress, I've consistently opposed the idea of the CAT, the Consolidated Audit Trail, under both Republican and Democratic leadership. because I think it's unnecessary, and I think it's a very, very costly intrusion to the marketplaces, and all those costs will be borne by mostly retail investors the way this is structured now. And the reason I oppose it too is substantively every analytic surveillance tool that the Commission or FINRA need that might be contemplated in capturing every brokerage account and every trade for every American citizen can be done under the rules now, under the surveillance policies now of both the exchanges and FINRA in their broker-dealer work. So I just view it as a catastrophically bad idea, and I think it outlines the risks of another giant federal database that people can query without a real rationale. So the SEC has spent a lot of time over the last year proposing rules intending to increase cyber defenses for every public company, broker-dealer, and fund. And Mr. Zhu, do you believe that the biggest cyber vulnerabilities, what do you think the biggest cyber vulnerabilities are of the consolidated audit trail? And are you concerned about cyber vulnerability of collecting that data in the CAT?
Congressman, I think you raised a really important issue that resonates with all of us. I think the protection of customer information, customer data, is of the utmost importance. That is why I think in 2010, the Commission has issued exemplary relief so that the most sensitive personal identifiable information, such as social security numbers, account numbers, and full date of birth, will not be collected by CAT.
But don't you agree that you still have the ability in this kind of a database to expose that, and the federal government doesn't seem to have a very good track record in that? And I'll give you an example. Geographically, if in Little Rock, Arkansas, there's a huge trade in a couple of different stocks, I mean, it's identifiable who it is. And if that number was released to the public, that could be very damaging to somebody's privacy, even if you don't know their name or address. So I think this policy has got concerns, and what kind of screening would be required for anyone who has access to looking at the CAT? What qualifications would they have? And how many people is that? I read that it could be 3,000 people. Is that true? Have the opportunity to look at this database?
Congressman, currently the Commission is evaluating the common file on the rule proposal issued under former Chair Clayton about the data security of CAT. I would also want to add that CAT is a system run by the self-regulatory organizations. It is not a system run by the SEC.
Yeah, but let's not hide behind the fact that it's done at the direction of the SEC. So would you say the FINRA agrees with the CAT proposal from the Commission?
It is a proposed rule that we receive a lot of comments. We're evaluating them very carefully.
All right, let me change subjects. I'm not going to make much progress there. Let's turn to your Treasury dealer proposal. Here you're trying to sweep up people who are Treasury buyers and suddenly rule them as dealers. And you've defined the quantitative threshold as a dealer is somebody buying or selling $25 billion in U.S. Treasuries in 4 of the past 6 months automatically makes somebody a dealer. Now, on a bipartisan basis, we've objected to that. We don't understand the rationale for it, and on a bicameral basis. So, have you researched how many firms would be impacted on that definition? How many people now do you think are suddenly Treasury dealers because they buy Treasury in quantity at that level? How many people are we talking about? How many firms?
In the proposal of the dealer rule,
I know what it says. I'm asking you, based on that quantification of the amount of Treasury securities, how many entities might be swept up in that definition?
Given the available data, as it says in the release, if I recall correctly, this between 20 and 30 entities. There were comments from the common file suggesting that there are others who might be sort of tripping that threshold, and we are currently evaluating the common file.
Okay, thank you. Madam Chair, I yield back, but I'll submit these questions for the record. Regretfully, thank you.
Thank you. The gentleman from New York, Mr. Meeks, is now recognized for 5 minutes.
Thank you, Madam Chair. Let me start with Dr. Shu. The last time the SEC pursued major market structure reforms, it held public hearings to receive input from market participants before and after releasing the proposals. And ultimately, the SEC reported regulation NMS in response to extensive public comment. Now, I've heard from a number of stakeholders, and particularly from New York, that the process for developing the 4 equity market structure proposals released last December was entirely different. It was different. So what I'm trying to understand is, why did you take a different approach on the equity market structure proposals than you did with the regulation of the NMS proposals?
Congressman, thank you for that question. I think this is a really important topic that we do engage with the public extensively throughout the rulemaking process, and that's what we did. Ever since the regulation AMS adoption in 2005, the division staff have been engaged with the public and generally market participants very extensively. And in fact, some of the ideas that we eventually proposed were supported by the market participants, at least I would say 5 or 10 years ago. And we had extensive meetings with the industry and also with a broader set of market participants. Staff have attended industry conferences. We read industry white papers. So there was an extensive period of discussion with market participants. And also, after the proposal, we have received thousands and thousands of letters from individuals, from trade associations, from institutional investors. So we do believe the public does have the opportunity and they are able to weigh in extensively as they can, as they wish in the rulemaking process.
I'd go back and forth with you because, having public proposals with one way, I think we can debate that issue. But let me jump to something, and I'll go to Director Wachter on this, because this is something that's important to me. Since I've been in Congress, my goal has been to ensure that people from all backgrounds have access to opportunities to create wealth and establish financial well-being. I think that's tremendously important. And last week, I reintroduced the Improving Corporate Governance Through Diversity Act with Senator Bob Menendez. It has received bipartisan support in the past, and I hope that we get it done now. But in addition to representation, I think that we must always look at policies and proposals through the lens of whether they are treating people equitably, and especially if there are negative economic impacts through unintended consequences. So, Dr. Wachter, last year's omnibus appropriation bill included language that strongly encourages the Commission to reconnect the economic analysis in the private funds advisor proposal to ensure that analysis adequately considers the disparate impact on emerging minority and women-owned asset management firms, minority and women-owned businesses, and historically underserved communities. So can you tell us, what is the status of the reconducted economic analysis?
Congressman, we are currently working on that economic analysis as part of the adoption of the private funds rule.
So we don't have from then to now, there is, you haven't finished it. Well, the question then is, do you have any initial assessment on the impact, what it would be to minority and women-owned law firms? Is there any assessment that you can give us at this time?
So the concern about women and minority firms comes from the fact that the academic literature shows that those firms tend to be smaller. And it is possible that there may be a disproportionate impact on smaller entities. This is what the comment file says. So we're evaluating those comments at the moment, but it is an issue that is under consideration by my division.
Well, it's under consideration, but is it a priority?
We conduct an economic analysis for every proposal in rulemaking, including this one. So we are carefully considering it, and we share
there's
your
considering it one, and there's considering when you have priority. Is it a priority?
Congressman, we share your concern about these costs very much.
Gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. I'd like to begin by focusing on a proposed rule pertaining to security-based swaps. The SEC's proposed Rule 10B-1 would require public dissemination of security-based swap positions. Market participants are concerned that this would deeply harm market liquidity. In November of last year, I sent a letter to the SEC with several of my Republican and Democrat colleagues on this committee regarding this proposal. We specifically asked if the Commission support an approach that requires confidential reporting, noting that the potential unintended consequences of public dissemination. Now, I was pleased to see that the SEC reopened the comment period yesterday, and I'm optimistic this will give the SEC more time to review existing data and appropriately consider bipartisan feedback. Dr. Zhou, has your division considered a phased approach to implementation, first analyzing the confidential data before mass disseminating the information out to the market?
Congressman, thank you for that question. Also for recognizing we indeed reopened the comment period for 10B1, accompanied by an economic analysis, additional data analysis produced by colleagues in the Division of Economic Risk Analysis. To your question about the phased implementation, including the reporting to Commission before public dissemination, it is one of the comments in the comment file, and thank you for that letter, which I've read. This is something we are considering very carefully right now.
I'm very concerned, I will acknowledge to you, about the major impact that this rule could potentially be on the credit default swap market. The CDS market is critical for banks to be able to manage risk, so harming liquidity in this market would have major implications for safety and soundness of the banking system. So I ask, has the SEC discussed this rulemaking with the Treasury, the Fed, or for that matter, the OCC?
Congressman, this is a Dodd-Frank rule because this is the congressional mandate, so we implement it this way. I can get back to you on all specifics of the discussion if there's any.
But you see where I'm coming from. When we pass rules that have possibly dramatic effects on financial institutions' ability to use the market system to protect themselves and their depositors, it would seem that it's only logical that the Securities and Exchange Commission would discuss that with Treasury, the Fed, and the Office of the Comptroller of the Currency because of the potential effect it would have on their responsibilities. So, okay. We'll continue with you, Doctor. On March 9 of this year, the Division of Investment Management proposed a new rule to address how investment advisors safeguard client assets. The proposal would expand the scope of the Commission's custody rule to encompass all assets. Now, many industrial participants have expressed concerns that this rule could have a negative impact on several traditional financial markets in conflict with regulatory frameworks overseen by the Division of Trading and Markets. Think of such things as prime brokerages and derivatives. More broadly, there's been widespread concern from the commenters that the proposal would result in worse outcomes for investors. Did the Division of Investment Management consult with you before issuing the proposal? And did your division provide any feedback or raise any potential concerns?
Congressman, the Division of Investment Management did consult with us, and we provided our economic analysis, as we always do on rule proposals.
Did it have any effect on their action? Your response?
These questions.
I ask those kind of questions because that's what
Questions
I'm
about
curious
this
about.
may be best directed to the Division of Investment Management.
With that, Madam Chairman, I think I have an answer. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes, sir.
Thank you very much, Madam Chair. I appreciate the opportunity, and thank you for holding this hearing. I thank the ranking member. Dr. Sue, I'd first of all like to thank you for sharing your love for America, for our country. It's always heartwarming to hear a new American say how much they love our country. We are that shiny city on the hill. I still believe that, and thank you for that. I appreciate it. I have to say that this hearing has reminded me of a hearing that I was in about 20 years ago in the Assembly in California, Business and Professions. We decided that we weren't going to bring the normal people that would testify. We'd bring world-class experts, and this is on podiatrist versus orthopedics, to find out how far the orthopedics could go up the ankle and up the leg. And when we brought them in, we asked them very complicated questions that we didn't know were complicated, and they gave us very complicated answers that we didn't understand. We got frustrated, they got frustrated. It was actually quite interesting to watch, because not that they were stalling or anything like that, is that when we'd ask a simple question about vascular circulation or bone structure, it wasn't a simple question. It turned out to be a very complicated question, and we wanted a simple answer. There was no simple answer. And I feel a little bit like that today, a little not frustrated, but just it's fascinating. It does take me back a few years. Climate change presents a direct threat to our nation's capital markets, critical infrastructure, and economic growth. The Office of Comptroller of the Currency states that climate-related risks can affect the safety and soundness of banks through physical and transition risks, which affect various sectors of the economy and may affect access to financial services and fair treatment of customers. The Treasury's Climate-Related Financial Risk Advisory Committee, quote, identified climate change as the emerging and increasing threat to the U.S. financial stability. The International Monetary Fund's Office of Finance and Development stated that climate change will affect monetary policy by slowing productivity growth, increasing market uncertainty, and inflation volatility. With that in mind, last March, the SEC proposed rule changes that would require companies to disclose standardized information about material climate-related risks that will have an impact on business operations. And as co-chair of the Sustainable Investment Caucus, I applaud the SEC's listening to thousands of investors, fund managers, industry advocates, legal scholars, and market professionals. These standardized disclosures will provide market participants with clear information to protect themselves from risks and make the best financial decisions for themselves and their families. Dr. Wachter, thank you for leading your expertise in testifying today as Chief Economist and Director of the Divisions of Economic and Risk Analysis. You are tasked with integrating financial economics and rigorous data analytics into the SEC's policymaking rule, making enforcement and examination. Pertaining to the upcoming climate disclosure rule, I would like to ask you to discuss your understanding of our capital markets as it pertains to climate-related information.
Congressman, so we have a situation with the climate disclosures that many companies are voluntarily disclosing climate risks, but these disclosures are necessarily not entirely consistent because there's not some common regulatory framework. And so because they're not as consistent, they're not as useful for investors. So we can tell that there is investor demand for this information because companies are providing this information, among other reasons, and yet we don't have a consistent framework for disclosure, and I think that makes it more costly for everybody.
I agree with you, and it is, in fact, the case that many investors are asking for this information. They want to be good citizens. They want to be good stewards of the world, and so they do ask for this information, don't they? I mean, isn't that the reason that the companies are putting it out there? I mean, I don't have anything against companies. I actually like big companies, but the reason they do that, I assume, is because investors are asking for it.
I would also assume that that's why the companies put it out, because the investors want it, yes.
Yeah, I think that that's absolutely the case. A whole bunch of us want to know, is this company a good actor? Is it a good actor environmentally? Is it a good actor, and what is it doing to either help climate change in a positive way and not in a negative way? But anyway, again, I thank you for being here. I don't feel the same frustration as others, but it was certainly entertaining. Thank you very much, and I yield back.
The gentleman yields back, and the gentleman from Wisconsin, Mr. Steil, is now recognized for 5 minutes.
Thank you very much, Chair Wachter. Appreciate you being here today. I got to say, some of the conversation today is a bit disturbing.
when we look at the lack of analysis being presented to us. And I don't know how we don't take that into account when we go through the appropriations process with the work that's going on at the Securities and Exchange Commission. Securities and Exchange Commission, the mission is to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation. Do you agree with that, Mr. Zhu?
It is indeed our mission.
Okay, so that's the framework with which we're looking at, and where before us is a pretty radical overhaul of the U.S. equity markets, and I'm concerned about the absence of stakeholder input in the rulemaking process. So let me dive in with a couple questions maybe to provide some clarity to those of us who are trying to understand the rules that you're putting forward. Some of the narrative I'm hearing, Mr. Zhu, is the narrative that's relating to the meme stock activity of 2021, justifying some of the rules that are being put in place. And we've had multiple hearings on this, and previously, then Chair Wachters and Mr. Green published a report laying out the causes of the trading disruptions and making concrete recommendations. And as far as I can tell, nothing the SEC is proposing in the market structure package directly addresses any of the concerns raised by my colleagues or others who studied the issue. And so as we look at the order competition proposal, is that directly related to the meme stock events of 2021?
Congressman, you mentioned the order competition proposal. It is a proposal that aims at promoting competition for a segmented set of order flows from individual investors.
Understood, but is it related to the meme stock issue of 2021 in your opinion? Is it related, yes or no?
The meme stock event certainly shows the surge of trading volume.
Yeah, no, I understand the meme stock, I understand the proposal. I'm asking, in your opinion, are they connected? Are they related? It's reasonable, yes or no?
The lack of sufficient competition in retail order handling certainly got exacerbated by the event in the meme stock.
So do you believe that this rule is in connection to the meme stock?
The meme stock event, as I said, it does make the insufficient competition issue in retail order handling.
You can't say if they're related. I'm just asking if they're related. I'm not asking way in the weeds questions here. Is it related to the meme stock event in 2021?
You could say they are related.
But I could say it, I understand. You're the expert in the space. I'm asking you if they're related. In your profession, you're pretty good at this stuff. In your professional opinion, are they related?
So I was trying to answer the question by saying that the meme stock event shows the surge in volume.
I'm not trying to be difficult here, sir. You're the expert in this space. I've seen a lot of proposal and rule regulation that say that this rule is because of the meme stock event. I'm just asking, as we look at this rule, is it related? You can't, I'll jump to the other. Best execution. Is best execution related to the meme stock event of 2021?
So with the best execution, I want to say that the best execution is a rule that spans all asset classes, whereas meme stock is only about equities and options. So in that sense, it is partly related, but I wouldn't say that meme stock event is the only driver.
Well, let me offer, since we're not getting kind of a clear, what I think is a pretty clear yes/no answer. I'll offer that if implemented, I think it could reduce liquidity in the markets, making the disruptions we saw more likely. Let me shift gears pretty significantly here in the limited time I have left to you, Dr. Wachter, if I can. Do you agree that the order competition rule conflicts with the best execution rule?
Congressman, I don't believe there is a conflict.
You don't believe that there's a conflict? I would respectfully disagree with you in that. How do you respond to the criticisms that the people that do believe that there's a conflict there exist? You can keep your mic on so we keep this moving.
So the criticisms of these proposals, these proposed rules, are part of the comment file. So we're going to respond, we're going to read those and evaluate those very, very carefully. We are concerned about, all of these comments, and we're going to do a careful evaluation when we go to adopt these proposals.
Let me just broadly, for the record, state my concern of the conflicts that exist, the lack of transparency in the analysis that you're providing. The U.S. markets are preeminent in the globe. This is a radical overhaul of the markets. There needs to be significantly more transparency as to the actions the Securities and Exchange Commission is taking. Recognizing my time, Madam Chair, I yield back.
Gentleman yields back, and the gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Thank you, Madam Chair. Dr. Wachter, thank you for being here today, and I want to follow up on Mr. Vargas's questions about the climate disclosure rule. Sorry, I'm right here. Do I understand right, you were involved in the drafting and the economic analysis of the proposed climate disclosure rule, is that true?
Yes, Congressman, that is true.
Okay. And you had mentioned to Mr. Vargas that the current situation is a lot of voluntary and non-consistent disclosure regimes. Is it safe to say that a part of the motivation was to create a standard set of regimes?
The motivation was to bring more consistency to the current situation.
Okay.
Yes.
And is it also safe to say that investors currently struggle to compare apples and oranges across various 10Ks?
Yes, I think they do. They're currently in sustainability reports, many of the disclosures, which creates a situation where you have some disclosures in the 10Ks and some in the sustainability reports in a manner that's sometimes inconsistent.
Okay, and that may relate, because I think when you'd mentioned, I think in your testimony earlier, that this creates an information asymmetry problem.
Yes, there is an information asymmetry problem here.
And do you believe that the proposed rules will address that concern?
They are intended to address that and to help with the information asymmetry and thereby improve liquidity and ultimately benefit capital formation.
To the benefit of investors?
Yes.
Great. Some of my colleagues here have raised concerns that this rule would burden small businesses and farmers, and I just want to give you a chance to respond. Before releasing the draft proposal, can you just talk about what you've done to look at the economic impact on smaller businesses and farmers, and specifically how you've seen the trade between presumably the gain from reducing information asymmetry to whatever burden might be imposed in additional reporting requirements?
Yes, so detailing those costs and benefits is one of the goals of the economic analyses. But this is a disclosure rule, and it's a disclosure rule for reporting companies, most of which are publicly traded. And so unless it's the small businesses and farmers are a reporting company, they wouldn't have to disclose under this rule. So the concern may come from the reporting of Scope 3 emissions if material, which doesn't apply under the proposal to smaller reporting companies, is my understanding. And also, any company is allowed to use estimates. So the costs for this proposal are borne by the reporting companies. Well, essentially it's a cost-benefit trade-off for the investors because they benefit, but companies they own, that's, if there's compliance costs, they would pay those costs, not necessarily the farmers.
Okay, so then I guess summing up, that it is your belief that markets will operate more efficiently with comparable and standardized climate disclosures?
Yes, that's my belief.
Okay, so we've got proposed climate disclosure rules. Obviously, we haven't seen them yet. They are squarely within your authority and your mission to protect investors. You've done the economic analysis. You've had goodness knows how many comments that have come through, and consistent with your obligation to maintain fair and orderly markets. That's terrific. As we know, the Europeans are ahead of us on all these things. They are putting out a bunch of rules. Lots of the companies who we all represent or have constituents who work there are often coming to us and saying, my employer is a multinational. They are, being forced to comply with these European rules. As a regulator, do you think it is in our interest to have a seat at the table and lead, or are we better off just sitting down and letting other countries take the leadership? Because after all, we don't have to work as hard if they do all the work for us.
Congressman, should any rules in Europe get developed prior to our rule, that will be part of the baseline, which, to use the technical term again. In terms of what our strategy is in terms of a seat on the table, I'm afraid that's out of my lane, so I'm not going to speak to that.
Well, I guess maybe I'll just close with the observation that there is a strong push here for you all to do nothing on this, with the assumption that in a global vacuum, no one else is going to act. And I realize that it's easier to stay asleep, but I'd like to thank you for staying woke. I yield back.
Gentleman yields back. The gentleman from Pennsylvania, Mr. Muser, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Dr. Sue and Director Wachter. So in 2023, the SEC's regulatory agenda, the SEC listed 29 items in the final rulemaking stage, and 23 items in the proposed rulemaking stage. So that's 52 items, which markets feel impedes the economy as a whole. So do you have, do you think that might be, take the time to implement one rule at a time in sequence so as the industry can respond back before the comment period ends? Is that something that has come to you, Mr. Sue? That the industry feels that you're moving too rapidly with new regulations that they don't have time to comment on? If you'd comment.
Congressman, this is you raise a really important issue. We take industry and market participant comments very seriously. Of the proposals, at least out of trading markets, we received
Those you claim to be serving don't feel that way. You must hear that. That the industry as a whole, securities industry, the stock market, right? They feel that the new rules are coming out far too rapidly.
Sir, with all respect, what we are trying to do is keep our rule books updated so that they remain fit for purpose for investor protection, for all the efficient market. And the market evolves fast, and as a result, I think we need to also act expeditiously to.
Okay, I mean, Rule 605, that's come up a couple of times. Why not let that be implemented, get some feedback, get an understanding, build off of it, rather than just have so many new rules in what we know is a rattled economy.
So you mentioned.
It's just going to keep moving at that pace?
Rule 605 is about public disclosure of execution quality. Some of the other rules we propose serve a different purpose for transparency, for example, for competition. So they solve different aspects of the market structure problems. We believe it is reasonable to think about them.
It makes sense that I think everybody that it would be, lay it out, get a feel for it, see how it works, build from there. So I'm not sure what the goal is in just moving as rapidly as you are, but it's not making your industry pleased. It's making them very, very anxious, actually, and it's making their lives more difficult. So let me just move on to something else. Dr. Wachter, last year, Commissioner Ueda pointed out that for a long time, the SEC uses a figure of $400 an hour to estimate the cost on companies they paid outside counsel. It was updated to $600, or with certain figures, the SEC quietly updated last year to $600, only after he pointed out the absurdity of the low $400. Was this being done? What was the point of holding that back? Was it just to keep costs artificially low that were being estimated, or what was the thinking behind that?
So I think you're talking about the cost estimates in the paperwork reduction section.
Yeah.
And we were very much appreciated Commissioner Ueda's drawing that to our attention. Okay. My understanding, this was in the Division of Corporation Finance, is that it was just a simple oversight.
Okay, all right, fair enough, that can happen. So as chief economist to the SEC, do you inform the SEC that the economy is quite fragile, that monetizing of the heavy debt, enormous, huge debt by the Fed, along with the escalated energy costs that are being borne, have led to inflation, which in turn have led to higher interest rates, which burden banks, families, small business, company performance, tax revenues, U.S. commerce in general. Do you inform that under these circumstances, we should try to avoid other regulations that also rattle and impede the overall industry and businesses as a whole?
Congressman, we are very cognizant of the comments in the comment file about concerns of regulations that may increase regulatory uncertainty. We've seen those comments. So those comments, like other comments, are those that we would address upon adoption of the rules.
It just seems that it's more of an attempt to control than it is to allow them to run efficiently on their own. Is that a macro view of things? My time has expired. I yield back, Madam Chairwoman.
Perhaps Dr. Wachter could respond in writing. Thank you. The gentleman from North Carolina, Mr. Nickel, is now recognized for 5 minutes.
Thank you so much, and thanks to our witnesses for being with us today. North Carolina's 13th congressional district is home to many exciting early-stage biotech companies working on critical life-changing technologies. These companies frequently have just a few employees. They rely on our equity markets to raise capital, often at the early stages of the company's formation, and often to fund clinical trials or to conduct critical research on the next groundbreaking medical treatments. I'm hearing from small R&D-focused companies in my district that they're concerned that the suite of equity market structure proposals and the order competition rule in particular may have serious negative effects on their ability to raise capital. Without effective markets, it'll be harder for the biotech industry to deliver critical drugs to patients. Director Wachter, do you agree that under the proposed rule, retail orders for smaller, less liquid stock are going to receive worse execution quality compared to the current status quo if nobody shows up for an auction?
Congressman, so evaluating the effects on capital formation, which is what you're describing, is part of what we do for every rulemaking, including the order competition proposal. And should this proposal add liquidity or lead to greater liquidity, we believe that it would improve price efficiency and could help capital formation. So our economic analysis shows that if you look at the companies that are not part of the S&P 500, for those companies, the stocks actually experience greater gains under our analysis from our proposal than the companies that are in the S&P 500. And so our economic analysis, and we're carefully evaluating comments, but the proposal and the economic analysis would indicate that this might not be a concern.
Unfortunately, it doesn't seem that the SEC did a comprehensive analysis of the proposal's impact on capital formation, and particularly on smaller public companies. Director Zhu, next question to you. Can you comment on why the Commission didn't do a deeper dive into the capital formation for these critical small companies? And again, we're talking about very small companies, like the ones in my district.
Congressman, the way that trading the market works is that we ensure that the trading of securities is well protected so that it is efficient, it is orderly, and that's a way for small companies to get the incentive to get listed and eventually come to the market. About the capital formation, I would defer to my colleagues in the Division of Corporation Finance about their role.
Since the rules were proposed, several new academic studies have come out with the evidence that the proposed rules would do the opposite of what the SEC claims. That means increasing costs for everyday retail investors. I'm especially concerned about reports that commission-free trading could cease to exist. Any increased cost on my constituents looking to save for retirement concerns me greatly. Director Wachter, has the SEC considered constituents like mine that are saving their hard-earned money for retirement and how these proposals may increase costs for them?
Absolutely, Congressman. We consider smaller investors and potential costs for smaller investors. In the economic analysis, we address concerns about the reduction in commission-free trading. That's something that we discuss. I personally, I always remember my grandfather who, he didn't go to college or high school, but he invested in the stocks, and he always told me, in America, nobody can erase your name from the list of stockholders. So I always think about him when I think about investors, and absolutely, this is something that we talk about and we consider.
The National Association of Security Professionals, which exists to support increased opportunities for securities professionals of color and fair access to investors of color, has expressed concerns that the SEC's proposals could, quote, result in the lack of access to the stock market for underserved demographics, which could further widen the existing diversity gap in investing, end quote. Director Wachter, will the SEC conduct an economic analysis available to the public that evaluates the potential disproportionate impacts of these reforms on low-income and minority investors like the ones that I represent in North Carolina's 13th district?
Congressman, I'm afraid that's something I'm going to have to get back to you on. We are following our time-tested proposal that's laid out in our policies and procedures on our website that we developed based on best practices from Congress and from the courts and from the executive branch in terms
my
of
time's expired. I yield
cost-benefit
back.
analysis.
Gentleman yields back. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. I have a sneaking suspicion that you have called this hearing with an understanding that members of this committee and subcommittee didn't beg you, but asked you for exactly what we are doing today. We're trying to provide feedback and we're trying to listen. And one of my colleagues just stated that he believes that this committee sees things exactly the opposite than the SEC does from feedback that we receive from people in our congressional districts. Job creators, investors, people who are trying to make a good idea work and to make this country better. That is part of capital formation. I don't have to ask you, I'm going to tell you, we believe that what the SEC is doing is destroying capital formation. We believe that the rulemaking, oversight, and legal authority that you many times call discretion has become weaponized. It is not helpful to capital formation. And I would tend to offer to Chairman Gensler and you, we heard from the General Counsel this morning, that you simply take off what you're not going to be supportive of, and that is that one of the things that the SEC is about is capital formation. You're destroying new opportunities, IPOs, people who would wish to come into the marketplace. The big arm of government, which the SEC has, is unprofessional and I think could care less about the capital formation. They view themselves as they've got a role to do and by God they're going to go do it. Rather than effectively understanding the marketplace, understanding costs, understanding time frames, understanding how important the growth of America is. We have, since 2010, more than doubled the revenue that comes in to the federal government. So Uncle's doing quite well. In 2010, we had about $2.4 trillion worth of revenue by the federal government. The free enterprise system, not government, produced almost $5 trillion last year. It is growing. It keeps America to be what would be the capitalist market that other countries would want to look at and emulate. That is your job. Your job is to review and look at things, not to get in the way, not to take all the time of hundreds of days before you respond back to someone that is in your sights. It is to listen to America, not the world. It is to come up with a firm definition and come back to this committee and the Senate committee to talk to people who are in the marketplace, to hear their ideas about how we grow capitalism in the world. Over and over and over today, all I've heard members do is seemingly say that you're out of touch. Those are not my words. That's almost every single person that has spoken today.
It's not just a frustration, it's a reality. So I would hope, Chairwoman, that you would, as we thank our witnesses who've taken time to be our guests today, that we would remind them in some reform, because they will get a letter from me and the gentleman, Mr. Lucas, and I know the gentleman, Huizinga. We want to send them a letter and say, thank you so much for taking time to come see us. We'd like to offer our feedback. And that is that we believe that the SEC does not live up to the term of understanding capital formation to the positive benefit of capitalism to support the United States of America and small business to make it work in this country. Madam Chairman, I yield back my time.
Gentleman yields back. The gentleman from Massachusetts, Mr. Lynch, is now recognized for 5 minutes.
Thank you, Madam Chair. First of all, I want to thank Dr. Zhu and Dr. Wachter. Thank you for your willingness to come before the committee and help us with our work. I, too, am concerned about capitalism, but I want to remind my colleagues, I was here in 2008. Dodd-Frank, when it was passed, required about 300 rulemakings, many of those directed to the SEC. And the reason they were passed was because back in 2008 and years after that, Congress actually passed the TARP Act that gave $700 billion to the banks because they had so screwed up this economy. They took the economy down. So we reverted to socialism. When we took $700 billion from the people, taxpayer money, and gave it to the banks. That's not capitalism, that is socialism. We didn't let the banks fail, we took $700 billion. Some of my constituents didn't even have a bank account, and yet they were held responsible to bail out the banks, many of whom their CEOs took bonuses for actually putting America's economy in the toilet. And so that's why we're here. That's why we're here. Because it wasn't capitalism. It was socialism that we were trying to address, and we don't want to revisit. You know, the United States capital markets are the envy of the world because of the work the SEC does. Because you're there to protect investors with the rule of law. You're there to maintain fair and orderly markets. And you're there to make sure that that everyone has an opportunity, a fair opportunity to engage in those markets. So, Director Wachter, I would like you know, at the beginning of this, we got off on the wrong foot, and I think you were shut down on some of your answers, but if you would take some time and just walk us through the rulemaking process. You know, I know that the industry uses cost-benefit analysis as a weapon against rulemaking. They go into court and they challenge it. They also, in some cases, insert provisions in legislation requiring what I think are needless obstructions and additional burdens for the SEC. But if you could walk through, talk about setting a baseline, talk about the process for rulemaking and how that has worked in the normal operation of the SEC where you work.
So I would be happy to talk about the process by which we do economic analyses. And I'll just say to your point that the economic analysis is how we make sure that the rule has its desired effects and promote the kind of outcomes that we want to avoid the kinds of situations that you describe. So a number of the rules that we're working on do have a resiliency measure. So our economic analysis has 5 components, generally speaking, and one of them is why are we doing the rule? So we do always have to answer that question, why, and communicate the why to the American public. The other part is the world as it is, because you want to be measuring with a common yardstick, and that's what we call the baseline. Then we talk about the costs and benefits of the rule, alternative approaches, including less burdensome ones for industry, and finally, we have to talk about the effects on efficiency, competition, and yes, capital formation. So that's in the statute, so we have to consider those. So we do that, perform that economic analysis on every proposal. It goes out for public comments. Many of these questions are reflected in the comment file. That's how the process works. And then we incorporate the comments when we go, if we go, to adopt the rule.
Thank you. You know, it's ironic that when we passed Dodd-Frank and gave the SEC the responsibility for restoring trust in the markets, that the industry is pushing back. They're pushing back on the measures that Congress passed to make sure that that type of disaster never happens again. And I just want to thank you for your willingness, for the work that you do each and every day, and on behalf of the American people. Thank you, and I yield back.
Gentleman yields back. The gentleman from Iowa, Mr. Nunn, is now recognized for 5 minutes.
Thank you, Madam Chair. Appreciate you convening this committee today. I want to also get right to the point here with our 5 minutes. I'll be candid. I have some grave concerns right now about what's happening at the SEC under Chair Gensler and on both of your watches. From my understanding, the U.S. capital markets are the most liquid and cost-efficient of any in the world. They are highly competitive and traded across a variety of market centers, both public and private venues. Colleagues on both sides of the aisle today have talked about your best practices. So, Dr. Xu, I want to begin with you. Best practice. Is it best practice to hone regulations to improve the market?
We're trying to improve the market as much as we can.
So that's a yes. 2, is it best practice to solicit feedback from the public?
We consider public feedback extremely seriously.
As do I. 3, is it best practice to improve capital formation?
It is part of our mission.
Good. Traditionally, when regulatory agencies introduce new regulations, they follow these best practices in response to the market failures or when directed by this body in Congress. However, there is a 1,600-page proposal that the SEC does not clearly identify either a specific problem it aims to address or a compelling reason why such market changes are underway. This is a direct reflection of Chair Gensler's direction on where these proposals are going. Additionally, Congress has no way to mandate such sweeping reforms, but the SEC has taken it upon themselves. So, Director Xu, I want to speak specifically. This past February, the SEC Investment Management Division proposed a rule, the Enhancing Safeguard for Registered Investment Advisors, under the guise of enhancing the protection of customer asset management by registered investment advisors. I think we all agree it's important to protect our customers' assets. In fact, it's essential. But this rule goes well beyond that stated intent, and in some instances would impose new rules that are impossible to comply with, thus potentially preventing the use of risk management tools which are so essential by the end user, and important to states like my own in Iowa in everything from the ag industry to the energy industry. Are you aware that under the new SEC proposal, the registered investment advisors would be required to use qualified custodians for client assets, including their derivative contracts?
So the rule you refer to is issued under the Advisors Act. It is outside the remit of the trading market, but we'll be happy to...
Are you aware of it or not?
I'm aware of that rulemaking.
Are you aware there's no framework to allow for the custody of a derivative?
But again, so this is under the remit of Advisors Act, and I have to defer to my colleagues in the Division of U.S. Management.
Dr. Wachter, are you aware of it?
Aware of the rule of the custody proposal, yes, I am aware of it.
And are you aware then of the derivative custody portion of it?
Yes, I am aware of the
Good.
derivative portion of it.
Perhaps I'll direct most of my questions to you going forward here. Given that this rule has a direct impact on the markets, were either of you consulted in this rulemaking?
So we performed an economic analysis as we do in every rulemaking.
And you provided that back to the SEC in your case?
Yes, we did.
Prior to the proposed rulemaking, did you consult with the CFTC about the potential impact on the future commission's merchants and their end user clients like my ag producers?
My understanding is that there were conversations with the CFTC prior to the proposal.
Do you know who at the CFTC was consulted on that?
No, I don't.
Dr. Xu, do you have any idea?
I don't.
Copy. All right. With my time remaining then, the Commission acknowledged that the best executional proposal, if adopted, this best execution regulation could actually result in increased cost and commissions for retail investors when, today, Iowan investors enjoy commission-free trading. Dr. Xu, do you think it's in a retail customer's best interest to pay more for services that today they're already getting for free?
Congressman, we consider the cost to retail investors very seriously, and the costs, of course, include commission, but then there's also a component, which is the bid-offer spread.
Today, they're getting it for free. Under the new rules, they'd be paying for it, right?
No, we have no reason to believe that the commission would come back under the new.
For the record, Dr. Xu, is it true the SEC acknowledges that orders are also more likely to receive price improvement, and with that, receive greater price improvement when routed to the wholesalers as compared to exchanges?
Currently, wholesalers have a first right of refusal to interact with retail orders. This segmentation is the main reason why investors currently are sending the orders there. And
Madam Chair, thank you. I yield my time back, and I'll send my questions directly to Vice Chair Gensler, since I'm not getting what I need here.
The gentlewoman from California, the ranking member of the full committee, Ms. Walters, is now recognized for 5 minutes.
Thank you very much. Director Wachter, the Division of Economic and Risk Analysis conducts cost-benefit analysis for the various rulemakings put forth by the Commission. However, critics have pointed out that such analysis can have substantial shortcomings and is used by opponents of a regulation to either dilute or strike down regulations. For example, critics have asserted that cost-benefit analysis is inherently biased in favor of the regulated industry, since costs of compliance are generally much easier to quantify in dollar terms than the benefits of regulations, such as improved investor confidence and market stability, which have a comparatively larger non-monetary component. What are your thoughts on the risk associated with biased data? Shouldn't regulators view the quantitative cost of under-regulation just as highly as the quantitative costs of regulations? Qualitative as just as highly as the quantitative cost of regulations.
Congresswoman, thank you for your question about the cost-benefit analysis and the qualitative versus the quantitative. And we are aware of that criticism of cost-benefit analysis and of economic analysis. Let me just say that I'm very proud to be leading the division of the economic and risk analysis, and I'm also very proud of the work that our staff does. The bias, you're referring to the problem of biased data. Data comes into us all the time. Data is just a measurement of something, and the data could be wrong, could be noisy, we call it, so that's statistical noise. Bias is when the data all tends to be noisy in one way, and that's a problem if the data have bias, absolutely.
Well, let me just stray for a moment from further asking you information about that issue. Let me just say that I appreciate your appearance here today. I appreciate the appearance of your colleagues also today, Investigation and Oversight Committee. You guys have been taking a beating from the colleagues on the opposite side of the aisle. You are our cops on the block, and Gensler is highly qualified and is doing an excellent job. So I want you to continue to do the work that you are doing, the work that you are mandated to do, and I do not wish you to be intimidated at all by unreasonable requests or questions. I've heard the information today about the kinds of documents and information that's being required. Reams, millions of documents, et cetera, et cetera. And if you expect it to turn them around in a short period of time or to disregard your mandate and your responsibility, you have to resist that. And so, on behalf of those on this side of the aisle who appreciate the enormity and the complications that you're dealing with, continue to do what you're doing. You're on the right track. Again, I can't say enough. You're our cop on the block. And what we need to do is make sure that you have more resources to work with. Members on the opposite side of the aisle have insisted on starving you to death and not giving you the resources that you're needed. You need more resources, you need more personnel, but you keep doing what you're doing. There are some of us who are very appreciative for your work, and we're going to always support you in every way that we can. And I yield back the balance of my time.
Gentleman from New York, Mr. Garbarino, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you so much for having this hearing and having these witnesses here. Witnesses, thank you so much for coming. Director Zhu, I'd like to follow up on an issue that I raised with Chair Gensler in April related to an inconsistency between two rule proposals you have pending. The first is your proposal on short sale disclosure, which it seems to me prudently excludes individual position reporting to avoid negative consequences such as copycatting and herd behavior. This disclosure contemplated here is only on a monthly basis. By contrast, the proposal on securities-based swaps disclosure, Rule 10b-1, explicitly requires individual position reporting at a relatively low threshold versus the market cap of many stocks on a very aggressive timeline of 1 day after the trade is placed. So I want to understand the distinction. Has the Commission made a determination that concerns related to front-running, copycatting, and herd behavior, which are clearly risks associated with the short sale disclosure, do not exist in the case of security-based swaps disclosure? And if so, how did the Commission come to that conclusion, and what type of cost-benefit analysis was performed drawing that determination?
Thank you, Congressman, for that question. Both of the rules that you mentioned, one is about short sale disclosure, the other is about security-based swap disclosure. They are authorized by different segments of Dodd-Frank Act, and we're working currently to evaluate the comments received. As you pointed out, in the short sale disclosure proposed rule, we have the data come in and they are anonymized and aggregated. So that is sort of partly in the congressional mandate, sort of providing the data and transparency in an aggregated fashion. I think 10b-1 serves a slightly different purpose. The purpose is to provide transparency of large concentrated positions. So they come from slightly different segment of the statute, and we are working very actively to evaluate the comments, including the one you mentioned today, which is also shared by some commenters.
So, but I would think that copycatting and herd behavior would be consistent with both, and I don't think it's a very large position under the new 10b-1 proposal that is being considered. So, is there cost, and so I don't understand, was there a cost-benefit analysis done for the 10b-1 proposed rule?
Congressman, since it's my division that does the cost-benefit analysis, does the economic analysis, yes, there was an economic analysis for the proposed Rule 10 capital B.
Okay, I'd like to know how, that cost-benefit analysis could differ from the other proposal dealing with the short sales, because I would think if it's good for one, it's good for the other. And right now, I understand that under short sales, copycatting and herd behavior could be very dangerous. So I would think that would also apply to the 10b-1. So I appreciate that. Director Zhu, I also have significant concerns about recent developments with the proposed consolidated audit trail, a substantial database with personal information of millions of Americans that only the SEC will have access to. My concern specifically is about the costs associated with this database, which has gone way over budget. For instance, the current tab for work already done is estimated to be roughly $350 million, and an annual operation costs are projected to be roughly $250 million, more than 5 times what was originally projected. And this is all going to be paid for by everyday Americans. Why has the cost to build and maintain this government database spiraled out of control, and what is the SEC doing to rein in the costs?
Congressman, you mentioned about the data security there and also the funding. Let me just first start by saying that we take the customer protection data, protection of customer data very seriously. the SEC has issued exempt relief so that the most sensitive personal information, Social Security numbers, full date of birth, and account numbers do not come into CAD at all. Regarding funding, the industry has, I guess ISROs have submitted a few rounds of funding proposals, and we are currently in the process of evaluating the latest one.
Can you describe what interaction you've already had to date with the committee responsible for implementing CATs? Can you provide the committee with your communications with NMS committee regarding the development of CATs?
So the Commission has regular discussions with the operating committee of CAD.
Okay. I appreciate it. I have another question, but I don't think I have the time to get to it, so I yield back.
The gentleman can submit it in writing if he'd like. The gentleman yields back, and the gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes.
Thank you. Thank you, Madam Chair. Thank you for being with us, Dr. Wachter and Dr. Zhu. Thank you very, very kindly for showing up today. I believe unapologetically in diversity. Sam Brownback, some of you may remember the name, who served in the Senate from the neighboring state of Kansas, delivered a speech once, and I remembered his words. He said, "A democracy thrives on diversity, and tyranny oppresses it." And I thought, well, that was powerful and very real. No culture can live if it attempts to be exclusive. Those were the words of the great Mahatma Gandhi. And I was mayor in Kansas City, and we had 6 firefighters killed one morning. Long story, I won't go into it. It was intentional. And so as I was meeting with Local 42, the firefighters, weeks after the explosion, I asked them, what is the tool you need most? What do you need most? And they said, a working ladder. A working ladder. And I embraced what they told me, because I think that's also the thing we need in society, a working ladder. And that's why I am very much concerned about and interested in inclusion. And the lack of inclusion in the financial service industry is prevalent at just about every level. Just one example, women and minority-owned asset management firms in the U.S. currently control a whopping 1.4% of the over 82 trillion with a T in managed assets in the United States, compared to the 98.6% of assets controlled by firms owned by men. And increasing racial and gender representation in financial services is something that I have sought to address and continue to pursue since I've been elected. Today, for example, Senator Cory Booker and I are introducing a bill, the Endowment Transparency Act, which requires certain institutional investors receiving federal subsidies to report on their businesses with diverse firms. And some college endowments to this day, are too embarrassed or scared to even disclose the fact that their billion-dollar endowments are doing very little business with women or minorities. In a word, pathetic. And so I would like to know, having wrangled with this issue, whether the SEC is doing the work necessary to to come up with some better numbers in the future. Either
Congressman, I can try to answer the question. So competition is one of the elements of our statute, and what competition allows is, I think it really goes back to the quote that you said, that we really need to bring the most diverse set of talents to bear, and that's just really important for any business and any country to thrive. And so I think competition's at the core of our mission. We consider it carefully in every rulemaking, including the private funds rulemaking, for example.
Yes, some of the most prominent universities in this country are almost barely an inch above progress in terms of this issue. Thank you, Madam Chair.
The gentleman from New York, Mr. Lawler, is now recognized for 5 minutes.
Director Zhu, the Office of Interpretation and Guidance within the Commission's Division of Trading and Markets is responsible for determining Section 31 fee rates, correct?
Congressman, I believe Section 31 fee rates is joint work between TM and DARA, but my colleague should weigh in here.
That may be my division, Congressman.
Your division determines the fee rate?
31B, we may need
Section 31 fee rate.
Section 31B fee rates.
You determine them.
We may need to get back to you on that.
I'm sorry, neither one of you know who determines them?
Congressman, perhaps if you could say a little more about Section 31B.
Okay. Section 31 fees are transaction fees paid to the SEC based on the volume of securities that are sold on various markets. These fees are intended to recover costs incurred while supervising and regulating the securities market. The SEC's Section 31 fee collections are used to offset the money appropriated annually to the SEC by Congress, and as collections are received, the appropriated authority is returned to the U.S. Treasury General Fund. The intent behind using funds collected from Section 31 fees to offset annual appropriations is so the SEC's funding can be deficit neutral. Do you agree with that statement? Either of you? Both of you?
My understanding is that the SEC collects the fees from the industry for its costs, yes.
Right, so to be deficit neutral, correct? So fiscal year 22 appropriations established the SEC's budget authority at $2 billion. However, in the SEC's fiscal year 22 agency financial report released last November, the Commission reported that the SEC collected $1.586 billion in Section 31 transaction fees in fiscal year 22. That is $414 million shy of its budget authority, meaning that the SEC failed to repay $414 million of its appropriations back to the Treasury. And for clarity, that's more than the entire amount appropriated to the CFTC that same year. For either of you, since the SEC undercollected on Section 31 fees and couldn't repay Treasury $414 million in fiscal year 22, have you done anything to evaluate or modify the Section 31 fee rates since then?
Congressman, my understanding is that sometimes we overpay, sometimes we underpay, and that this calculation is determined.
Well, in fiscal year 22, you underpaid. So are you doing anything to adjust based on the fact that you underpaid? Or is the SEC going to undercollect from Section 31 fees again this year? What's the plan?
Congressman, I believe the long-run plan is what you expressed, which is that we collect the fees to fund our operations.
Right, but you undercollected. So what are you doing to compensate for that? Are you looking at the fee structure? Are you going to make any changes, or are we going to plan on undercollecting again so that when you submit a nonsense report to us that says, as the SEC's funding is deficit neutral, any amount appropriated to the agency will be offset by transaction fees? It was not offset. So what are you doing to deal with that?
Congressman, I don't believe that there's ever a plan for us to undercollect. I think that sometimes there's undercollection and sometimes there's overcollection.
Right, but in this instance, you undercollected. So have you made any adjustments or even looked at it? It's a yes or no question. Have you even looked at how to deal with the fact that you undercollected last year? Yes or no?
We periodically adjust the fee. I believe there is a new adjustment earlier this year. We're happy to send you the details.
That would be wonderful if you could. By coming up $414 million short and paying back Treasury, the SEC is failing to be a good steward of U.S. tax dollars, and the claim that the SEC's funding is deficit neutral is highly questionable when you undercollect by that much. So you need to come back to us with a plan for how you're going to rectify that. The SEC recently proposed amendments to expand and update Regulation Systems Compliance and Integrity, SCI. The proposal would expand the scope of SCI entities to include certain registered broker-dealers for the first time. Feedback from market participants on this proposal suggests that the actual costs for this proposal are in the billions of dollars as a result of the SEC's attempting to micromanage the technology setup of individual firms. Yet these enormous compliance costs are conveniently absent from the SEC's cost-benefit analysis. Why did the Commission fail to acknowledge these costs in its economic analysis?
I'm sorry, the gentleman's time is expired. I'm going to ask the witnesses to respond in writing to the gentleman from New York. Seeing no more questioners on either side, I'd like to thank the witnesses, and without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. This is just the first of many hearings that we'll be having with you and your colleagues from the other divisions of the SEC, and I hope that they will be more transparent and forthcoming in their responses than we certainly experienced today. This hearing is now adjourned.